Hello, my name's Sarah Hare. Thank you so much for joining us today. This is our first quarterly economic update for the year. Time to hunker down, and just to remind you, as we start we'll just show the screen. So just to remind you today that everything that we discuss is general information only. We don't take into account any personal circumstances, and of course, before you do make any investment decisions, you should speak to a professional and do your research. So, joining us today is David Bassanese, our Chief Economist at BetaShares. Most of you are familiar with David, formerly with the AFR, Macquarie Bank, OECD and Treasury, and also not forgetting that David is the author of Australia's most extensive ETF guide, the Australian ETF Guide. So just to get into today, before we get into today, which we'll be covering our current state of play, the key risks and outlooks for the economy, and then we'll be talking about some investment thoughts. Before this, we would just like to get your ideas and your opinions on whether you think the RBA will cut rates. There's been this year. So there's been a few changing opinions, and then obviously our own economist has made his thoughts known. So we just want to know what you think. So looking, okay. So, and then our second poll, and then we'll be covering a little bit about this in the webinar, will be whether you think that the UK is headed for a hard or soft Brexit. So again, very topical. I think rarely a day goes by when it's not mentioned, and obviously implications. Whether it is hard or soft. So yeah, a little bit more strong feelings about this one. Just to also give you guys a look at how everyone's feeling, we are pretty much all on the fence here. It's a line call, 50-50 on whether the RBA will cut rates this year. A little bit more of a stronger feeling about the next poll, and whether there's a hard or soft exit in Brexit, for Brexit, with more people thinking that's hard. And given the time to the deadline, that's probably looking a little bit more likely too. So, without further ado, I'm going to hand over to our Chief Economist, David Bassanese, and he's going to take us through the session today. Welcome, Dave.
Thanks very much, Sarah, and thank you all for joining us today for another, I'm sure, action-packed year ahead. So I'm just going to go through, basically give you an update, the current state of play in the global economy, the Australian economy, financial markets, look at some of the key risks, both upside and downside, looking out for the year ahead, and what the most likely outcome, in my opinion, might be, and then with that, some investment ideas. I'm going to speak for about 30 minutes, and certainly if you've got any questions, you just sort of send them through, and we'll have some time at the end to answer more specific questions. Firstly, the big picture view in terms of the global economy. So this is a chart of global GDP growth. So those shaded lines, there are growth in each calendar year. And then the brown line is a global composite PMI indicator, which is basically a summary of all the global manufacturing and service sector sentiment indices that come out, and a group called Market put that together. As you can see, look, growth has been growing reasonably well, just under 4% in the high threes for the last few years. And the latest IMF forecasts expect that to more or less continue, looking at growth of a bit of a slowdown, 3.5 and 3.7 this year. And, you know, the IMF have talked a lot about, you know, downside risk, growth slowing, but at the moment, the forecasts are still fairly reasonable. you know, obviously the growth is likely to slow down a little bit from what we had last year, but we're not looking at this stage, at least according to the IMF, to any big slowdown. And, you know, I would broadly concur with that. I don't think we're likely to see a big slowdown, but I'll get into that a little bit later. If you look at some of the breakdowns of, this is a chart of growth across the major regions. The first line there, the brown line, is basically what the IMF expected growth to be in 2018, this time last year. The next dark line, bar is what growth at this stage is estimated to have been, and then we've got the forecast for 2019. So you can see that growth overall came in a bit weaker than expected. Well, at this stage is likely to be a bit weaker than expected at the start of the year, in 2018. But most of that downside came not from the United States. In fact, there was an upgrade to growth in the US from 2.7 to 2.9 on the back of the significant tax cuts that kicked in at the start of the year. But it was more disappointment in Europe and in Japan. And so, you know, that's I think that was the, you know, it's important to point out that it wasn't so much the US that did disappoint on growth last year. Even in China, according to the GDP numbers, there wasn't much of a slowdown last year, though as you'll see, some of the more partial indicators were a lot weaker through the year. So those GDP numbers in China, always a little bit questionable, and I'll talk a bit about that later. Yeah, so, and just in terms of Europe, I mean, Europe, the couple of issues. The slowdown in China through the year, particularly on exports, does seem to have hurt Europe particularly. Particularly the Germans and the French, the big exporters into China. Also, the new fuel emission testing standards, the transition to tougher standards in Germany disrupted car production for a number of months, and that hurt growth through last year. And then you've also got Italy, where sentiment has been undermined through budget wrangling and just, you know, weakening growth, loss of competitiveness. So Italy, for example, was in recession, had 2 quarters of negative growth quite late last year. Germany just skirted recession, so had a negative Q3 and a flat Q4. So avoided that sort of technical definition of recession. Technical recession, by that we mean 2 quarters of negative growth. Just avoided that. What's interesting though is if you look at other measures of growth, just going to the next chart, unemployment rates are at, and again, this is something I've been mentioning for a while now, unemployment rates have been nonetheless declining in most regions, and most particularly in the US, they're now down under 4%, and even in areas like and Europe, you know, by its standards, unemployment rate is relatively low, 8%, that it's getting as low as it was prior to the GFC. So what we're seeing is growth globally is not as strong as it was prior to the GFC, not as strong as it was in earlier years, but part of that slowdown is basically population aging, you know, slowing in labour force growth. Also unusually weak productivity growth, like most of the we've had good jobs gains, but pretty weak GDP growth. So it's been weak productivity growth. But nonetheless, even though growth is softer, it's still consistent with tightening labour markets, and in fact, even gradual increases in wages growth in most parts of the world. And I'll talk a little bit about that later as well, because it is one of the risk factors. Just going to the next chart, in terms of China. So as I said, the GDP numbers themselves, they didn't look like they slowed down all that much last year, but if you look at some of the more partial indicators, fixed asset investment, retail sales, infrastructure spending, they were more notable declines last year. And basically 2 things drove that. The ongoing trade tensions of the United States has undermined, you know, imports into the United States have slowed, because there have been some tariff increases already. And also some manufacturers in China have been relocating production to other countries such as Malaysia, Vietnam, to get around those get around those high tariffs they would otherwise face if they were to export out of China. So that's hurt. Also, the Chinese have basically still been grappling with their debt problems, the rising corporate debt, particularly among state-owned enterprises. And so they've had a tightening of credit conditions where they've asked, banks to rein in their lending, which has slowed activity, particularly, unfortunately, not only amongst the state-owned enterprises, but among the smaller firms as well. But again, China still retains a capacity to re-stimulate its economy if need be. So again, I'm not one losing much sleep over the growth slowdown in China. I think the trade tensions will be, well, I'm getting ahead of myself now, but those trade tensions I think will be resolved, and should they desire, they can boost overall growth again through yet another stimulus package. But that's the state of play. So the Chinese slowdown last year was also a feature. In terms of Australia, look, we have up until recently, have been enjoying reasonably good growth. I mean, that has continued growth, close to around about 3% or so, which is just above trend. This chart just shows you employment by sectors, just the broad-based nature of the employment gains we've been enjoying in recent years. The rollout of the National Disability Insurance Scheme has been boosting the healthcare sector. International education, so foreign students, has been boosting education in particular, and also construction. We had home building is at very high levels, and government infrastructure programs are also quite high. And if you just go to the next chart, you can see that that's been associated with ongoing trend declines in the unemployment rate since about 2016. So if you look at that first slide in the middle section there, the unemployment rate is now down to around 5%, which is pretty healthy. And wages growth slowly but surely, maybe not even surely, but has seemed to have bottomed and has picked up. So it was annual rate was running at under 2% earlier last year. It's ticked up to around about 2.3%. So look, wages growth in Australia is still lower than what the RBA would like, still lower than what would be consistent with keeping inflation or getting inflation into the 2 to 3% target band for the RBA. But up until now, at least it's been tentatively moving in the right direction on the back of a decline in the unemployment rate. So far, so good, but more recently, there has been a negative hit to some of our key growth indicators. Just a summary of slides there. The first one is the National Australia Bank Business Confidence Index. That really took a big tumble in December. It bounced back a little bit in January, but overall conditions now are quite a bit lower than what they were earlier last year and in 2017. Still by this measure a little bit above average, but nonetheless has been a notable turn down. And one of the reasons there has been the tightening of credit conditions, the banks tightening up on credit associated with greater scrutiny of lax lending, and that's particularly hurts the small business sector, where income verification, expense verification requirements have toughened up. The other chart there, building approvals, just below that. So this is home building approvals, council approvals to build homes. It's a very key monthly indicator, and as you can see, that was bobbling along for a number of years at a relatively high level, but more recently it started to take a significant turn down. So the last couple of monthly reads there, November and December, were quite weak. So it does suggest that the bottom is falling out of the home building boom. Which again is going to be, I'm not looking at the moment, the level of construction is still pretty high. There's still a pipeline of work to do in a number of high-rise developments across, Sydney, Melbourne and Brisbane particularly. But beyond that, the pipeline is starting to diminish. Also, ANZ job ads, the bottom line there, also starting to turn around. So just seeing signs that the economy is starting to weaken, the employment boom that we've been enjoying may well start to soften. If you just look at the various, going through the different markets, and this is just really a summary of what was happening in global markets through much of last year. You've got global equities, the ASX, bond yields and currencies. And essentially, look, markets took a tumble last year on the back of rising interest rate fears. So you can see global equities had a tumble in January, stage of recovery, then a more serious tumble than later last year. And initially on the back of rising interest rates, US interest rates in particular. And look, when at the end of the day, what happened last year, I think, is the Fed in the United States was continuing to raise rates, and they seem to be on a course to keep raising rates irrespective of, almost what was happening with the economy. Jerome Powell, the chairman there, a few loose words late last year, and it really unnerved markets. They have since changed their tune quite a bit. Now they're talking about being more patient and raising interest rates, and that's allowed the markets to recover somewhat through January, and also encouraging signs about the China-US trade talks. So the markets have rebounded after a particularly sharp decline late last year, but nonetheless still below the highs of earlier in 2018. Meanwhile, the US dollar was also generally strong through last year, again on the back of the US rate rises, and that helped drag down the Australian dollar. In terms of global themes, this is just a series of charts looking at some of our major global sector funds that you can buy, currency hedge ones, and this is the relative performance of these funds vis-a-vis the global markets. And so basically when these lines are rising, it means that particular sector or theme is outperforming global markets. And look, there's obviously a few themes sort of stood out last year. Basically a switch to more defensive areas like healthcare had a good run. Even gold miners, so the bottom line there, MNRS, which is a fund that tracks global gold miners, on the back of a rebound in gold prices late last year, there's flight to safety, gold miners have done well. Again, with the slowdown in Europe and Japan last year, their markets are HJPN and HEUR, which are Japanese and European equity funds. They did tend to underperform against global markets. And even global banks, which I have favoured on and off over recent years, did tend to underperform last year as global growth fears and concerns in Europe mounted, even though for the most of last year bond yields were rising, and generally bond yields are supportive of financial stocks globally outperforming. So that was a bit of a divergence there, where they did underperform, even though bond yields for most of the year was rising. Otherwise, the other areas of the market, just on the next slide, looking at again themes, unhedged. So again, these are another bunch of exchange traded products that we offer on the market, global exposures. You can see the Nasdaq, after several years of good outperformance, look, it didn't seriously underperform last year, but kind of tracked sideways global markets. One of the standouts is probably quality. So again, we have a fund that tracks company. Again, I'll talk a bit about this later, but in this sort of late stage of the cycle, companies with good returns on equity and low leverage tend to do well, and we certainly saw that come to the fore through late last year. A bit of an underperformance in the second part of the year, but generally the trend toward quality firms of late is being evident there. Has been evident. Global Asian technology, with the slowdown in China, concerns over China more broadly, you saw our robotics, which have a lot of Japanese exposure, and Asia, which is Asian tech companies, have tended to underperform through late last year. Looking quite cheap, but nonetheless did tend to underperform. And the other one there is HACK, our cybersecurity ETF, which is doing pretty well. It's held up vis-a-vis global markets through last year. In terms of Australia, this is an even busier chart, and again, I just put that there. You can sort of go through in a bit more detail later, but again, here's some of the major thematics that we offer in terms of products within the Australian market. I guess a couple of standout features there is the ongoing relative performance of resources. So the resources sector, and again, in that case, it's the QRE fund, has been doing very well despite the slowdown in China. And it's because A, the weakness of the Aussie dollar, B, the fact that iron ore prices have been holding up pretty well, and just the fact that, they've been churning out a lot of volume, volumes of iron ore and coal exports have been quite strong. So that's been a standout performer. And more recently, just if you look at the last bottom line there, the RINC, so that is a real assets, it's like utilities and property fund. has started to turn around, has outperformed late last year as interest rates started to decline. Bond yields and talk of the RBA raising rates certainly were being hosed down, and more generally a more cautious tone in market. So you may see that gravitation to property, utilities, infrastructure in our market. Small caps, by contrast, again, they've had a great run, but they tended to underperform through last year. But if you, in summary, you'd say it's still been resources and increasingly interest in property and utilities and those sort of parts of the market. So that's really just a sort of snapshot of where we've been. So now let me just focus going forward in terms of the key risks. Firstly, globally, of course, global trade wars are never far from investors' thoughts. Look, I've had a view, if you've been listening to these webinars of late, I mean, I've had a view through late last year that eventually I think there will be a resolution between China and the United States. I think both sides do see interest in resolving their differences and not escalating them, given the obviously not only the risk for the Chinese economy, but also the growing risk to the US economy with fears of a slowdown in the United States as well. And also to the share market. The fact the share market took a big tumble last year, I think will have Donald Trump on notice. The direct impacts of it, as it stands, the threat is a 25% tariff on Chinese imports if they don't manage to come to a deal by the end of March. The direct impact of that is still pretty limited if that was all that would happen. I mean, by my calculations, only about 0.6% of US GDP and about 1% of Chinese GDP. But it is that second round effect. I mean, if they don't manage to come to a deal and are still squabbling, by the middle of this year, I think that will take its toll on business sentiment and probably the share market as well. So it's an ongoing thing. Donald Trump, I mean, all the talk out of Washington has been encouraging. They're saying we're making good progress. The both sides are still meeting. Donald Trump recently said that if need be, he's prepared to extend that deadline. Currently, the deadline is a deal needs to be done, by March, or else he will, fire his tariff bullets. But he's open to extending that deadline if need be. So, look. So I think that obviously it's a lingering issue, but I think it's one that will eventually die down, even if it turns out that the trade package that they sign is not as extensive or as detailed as the US may have initially wanted. They nonetheless will be keen to sign a deal there. The other issue, particularly affecting Europe, is the ongoing tensions in areas such as Italy. So this is just a chart of the Italian 10-year government bond yield less the German yield. So when that gap, when that spikes higher, it basically shows increasing risk surrounding Italian debt, increasing fears of potentially Italy leaving the euro. Now that's an on again, off again dispute. There is a risk that, as I mentioned, Italy is now in technical recession, had a negative growth for 2 quarters late last year. They are saying they are going to achieve a budget deficit this year of about 2% of GDP. But the risks are that it's going to be higher than that, particularly given a weak economy. And if it is above 3%, then, the EU, which is above the EU limits, then, they could turn around and basically, fine the Italians by not keeping their ship in order. But look, it's a hard one because Italy, it's a weak economy, which typically pushes up the deficit. So the last thing you want to be doing when the economy is weak is austerity measures to bring the budget deficit in line. It's not going to win Europe many friends in Italy by imposing that, but it's just going to be an ongoing source of tension. Bottom line, though, it's still really just an issue for Europe and particularly Italy, rather than something I think that will spill over and have global market implications. But nonetheless, an issue that continues to need to be watched. And for example, there's likely to be a debt down. Italy's debt has been downgraded progressively over the years. It's just above junk bond status, the BBB rating. The rating agencies are warning that they may downgrade the rating a little bit more this year as well. So Yeah, so ongoing tensions in Europe. The other one, of course, is Brexit. I mean, many of you seem to suggest there will be a hard Brexit. I mean, the default position at the moment is, unless there is a deal done, unless the UK Parliament agreed to the deal that Theresa May put before them, that she agreed with the EU, the default position is there will be no agreement and there will be a hard Brexit, in which case, potentially very destabilising for the economy. A lot of debate as to how destabilising, but there's talk of, all the shipments of goods going across borders will need to be halted, and you need to do customs inspections, employment, cross-border service arrangements. All these things will be thrown up in the air, depending on, what provisions have been made. So it's hard, the other scenario at the moment is that maybe the Parliament agrees to delay the formal divorce, which kicks in at the end of March, and so that's something that bears watching as well. But so very very uncertain how the Brexit will play out. All I would say, and again, all I would say, I mean, for those that may not know, I mean, the key issue here is the so-called Irish backstop, where Northern Ireland, being part of the UK, as part of Brexit, would no longer be part of the EU. So given that Ireland itself would be part of the EU, were nothing to happen, you'd need to basically put in, customs arrangements and border patrols between those two parts of Ireland, which would, re-raise those tensions between Northern Ireland and the rest of Ireland. So no one really wants to see that, but it's hard to know how to get around that. Now, Theresa May's deal was basically to keep the whole of the UK as part of the EU customs union, at least for another couple of years till they can negotiate a free trade deal. And that would mean you wouldn't need to have a border or any controls between the Northern Ireland border and the rest of Ireland. But obviously many in the UK Parliament didn't want to stay part of that customs union, and there's the impasse. And it's really, at this stage, hard to see how they can resolve that. Moving right along, other risks, I mean, this is probably what I still consider the more important risk globally, is how the US will deal with the fact that the labour market is quite tight, wages growth is grinding higher, and the Fed may will need to continue to raise interest rates later this year. So that red line is average hourly earnings growth, and the green line is the unemployment rate. And if you look at where we are today versus where we were, say, even prior to the last three recessions in the United States, you had low unemployment, you had wages rising up to around 4% at that time, and you had Fed tightening. I mean, the Fed tightening itself wasn't the cause of the downturn, but it was certainly, or the sole cause, but certainly was a contributor to the eventual downturn in the economy. Now, the good news is that wages growth in the US is still not at that 4% level. It's at the latest readings around about 3.3. But nonetheless, the trend is pretty obvious there. It's been up, and if that continues to grind higher, I mean, I think the Fed may well need to come back into the picture. And if you just look at the next slide, again, so last year we had the situation where the Fed seemed to be intent on raising interest rates. Its projections last year was that the Fed funds rate would go from about 2.25% to about 3% over the following year. So another 3 rate rises, which spooked the markets. They thought the Fed might basically do a mistake and cause a recession in the US. The Fed has since changed its tune. It's talking about being patient in wanting to raise interest rates, and they've basically got rid of any kind of, strong signal as to what they will do with rates this year. The markets have gone right ahead and priced out any risk of further interest rate increases in the United States, as you can see from that dashed red line there. So there's the debate at the moment. I think the Fed aren't done. I think the Fed is on hold, but given the ongoing momentum in the economy, they will probably feel the need to raise rates again by around June, and possibly again September or December. So the markets, I think, will need to get accustomed to increases in rates, which could be a bit of a, it puts upward pressure on bond yields again and potentially downward pressure on the equity markets. But I will say a little bit more about the US in a minute. The other issue in Australia is the housing downturn. So, as I said, part and parcel of the decline in the indicators you've seen earlier is that fact that Sydney and Melbourne property prices have clearly come off their peaks. This is a chart of house prices to average incomes, let's say, in Sydney and Melbourne. This is based on end September levels. So since these charts were done, we don't have the next official ABS quarterly number for December. It comes out with quite a lag. So it is somewhat lower than what it was, but nonetheless, the fact remains that house prices relative to income and even relative to, you know, low interest rates and mortgage affordability in both states is still pretty high. So I think there's still more correction to come in both the Sydney and Melbourne markets, which is going to put some down, you know, undermine consumer sentiment and also undermine building approvals. Home activity. And if you actually look at the next chart, this is again my core view now is that the RBA will probably be dragged kicking and screaming to cutting interest rates later this year. It doesn't want to, but I think if the unemployment rate turns around and starts to rise back up toward 5.5%, given wages are low, given inflation is low, it will be under pressure, I think, to at least be seen to be doing something and cut interest rates. And this is a chart of the 12-month change in, the level of building approvals advanced 6 months. And then the dashed line is the 12-month change in the unemployment rate. And as you can see, a general tendency when building approvals have their big cyclical downturn, it tends to be associated with an eventual rise in the unemployment rate. And so I think as the year progresses, we are going to see some upward pressure on the unemployment rate. And again, the home building approval decline that we've seen is probably not ended. There's probably more declines to come over the next few months. So that brown line there could get even weaker. So that's one. And again, in terms of this is home building. The thing about home building, it's a big swing variable. So if you go from 20% growth in home building to minus 20%, it can have a major swing variable in employment, and also then in downstream areas like retail spending. And if there's fewer homes being built, there's fewer consumer durables and whatnot that need to be bought as well. The other factor is consumer spending, and this is really the big one. Is that the debate at the moment is what wealth effect will there be on consumer spending given the declines in house prices that we're starting to see, not only in Sydney, Melbourne, but even softening in other states as well. So this is a chart of the consumer spending versus household income growth, and savings ratio is really the difference between income and consumer spending. So as you can see, over the last few years, we've enjoyed consumer spending running ahead of income's growth, which has been quite weak. And that's been facilitated by declines in the savings rate, which arguably reflect two features. A, the fact that income's growth has been weak. Households have been trying to, support their spending by running down their savings a little. But also, the house price booms that we've enjoyed made households feel wealthier and more inclined to dip into their housing wealth and spend. That's the wealth effect on the positive side. So the risk now is that that wealth effect turns negative and maybe the savings rate levels out. So if the savings rate just levels out, it means consumer spending needs to slow right down to the pace of income's growth. And even worse is if it returns rebound somewhat, consumer spending will slow below income's growth. So that is again, consumer spending is about 60% of GDP. So if we do get a major slowing in consumer spending, that's going to have ramifications for overall GDP growth. So that's really the risks. I mean, as you can see, that most of the risks are sort of pointed to the downside, it's fair to say. I mean, there's one upside risk I haven't mentioned, and that is the fact that, it could well be that the very weak productivity growth we've seen globally and in Australia, so we've had relatively modest GDP growth but strong employment growth. That means that productivity growth has been quite weak. That businesses start to respond to labour tightness, as I've said, the signs of labour tightness, by boosting investment spending. So rather than just jacking up wages, fighting for scarce workers, or just, you know, closing down business because they can't find workers. They actually expand investment spending, and that is the next leg to growth. So that's a possibility. That is the upside risk. But again, most of the indicators I see don't suggest that, you know, business investment is, you know, businesses are starting to do that in a big way. So it's an upside risk, but one that I don't attach a lot of weight to at this stage, unfortunately. So in terms of investment thoughts, where does that leave us? So just this first chart is the global, so this is the global stock market, so the global MSCI index. Again, very big picture, going back to the mid-1960s, but allows you to see the big periods of the bull market periods we've been enjoying, and then the shorter, sharper bear market period. So more or less, we've been enjoying a bull market since the GFC. It's 10 years, almost the 10-year anniversary of the bottom in markets. But I think, and by historical standards, this has been a pretty long, it's becoming, you know, one of the longest bull markets we've enjoyed. I've had a couple of negative shocks more recently, obviously early January last year, and then more recently in December. So I think it's reaching a mature stage, and I would argue that, you know, the upside risks the downside risks are building relative to the upside risks, just as we're reaching this mature stage. And if you actually break down the various components of what's been driving the market, if you just focus on that period since the GFC, you can see the main risk is that, you know, from a valuation point of view at the moment, given the first line there is the PE ratio. So earlier last year, the PE ratio was arguably getting a bit stretched at around, you know, 18 times earnings. With the sell-off in the markets, it's now back to a more reasonable level. So outright valuations at this stage aren't a huge problem. Obviously, if they rebound back to where they were, that would be a problem. The market seemed to be uncomfortable with valuations as high as they got late last year. The other issue is that interest rates remain quite low, but again, if I'm right and the Fed starts tightening again, there's going to be upward pressure on interest rates. The bigger concern, and just the other one, is the so-called equity risk premiums. That's the difference between the PE ratio. If you invert that, you get an earnings yield, and if you take away interest rates, the gap between the two is this equity risk premium. Now, one of the challenges of trying to see if the market is expensive or cheap is that if you look at that risk premium over 50 years, there's no natural average. I mean, it was well above average in the 1960s, 1970s. Then for a period of time, it averaged around zero, and we used to think that it needed to be around zero for fair value. But really, since the 1990s, since the decline in interest rates to quite low levels, it's been at that, you know, quite a chunky positive. So the equity risk premium has been quite high again. So it's really hard to judge just by equity risk premium if the market is cheap or expensive. We can also only sort of go by more recent levels. And so on that basis, I would say the market also is probably not a screaming, you know, it's not screaming, you know, red flags at that point, you know, because interest rates are still pretty low. Valuations certainly not as high as we got, you know, during the dot-com bubble. But my bigger concern is just that earnings story. If you look at that bottom chart on the left, the fact that we've had a more or less a good earnings upturn. We're now getting close to the trend line, if not a little bit above. And just with the waning in growth, the risk to me is that earnings growth does start to slow. And even in the United States, you had very strong growth last year, and the earnings expectations for this year are starting to wane a little bit. You're looking at, you know, potentially flat to negative US earnings growth through this year. And I think that could be the thing that potentially causes the market some concerns. And just to underline that point, the next chart shows you, this is a long-run measure of reported earnings in the US. The focus on the orange line there, and you can see relative to the trend. So the two straight lines there are lines through the cyclical peaks of earnings, going back way back to the 1920s, and then lines through the cyclical troughs. And then the midline is basically the median between the two. And you can see that by historical standards, US earnings are very, very high, well above trend, and the expectations are that it will keep growing way beyond trend at the moment. But again, I think there's downside risks to the fact that given how stretched earnings are. And if you look at valuations, outright PE valuations based on the current level of earnings are not that bad, but it's based on earnings being well above trend. And if you actually look at prices relative to sort of more underlying trend measures of US earnings, valuations are a lot more elevated on that basis. So the market isn't really pricing in much downside risk to earnings at the moment. In terms of our market, again, more or less we've been enjoying the same bull market period. I think basically we're beholden to US markets. The earnings story in Australia overall, apart from say the resources sector, is still pretty soft. We're looking at, at best 5% growth in earnings over the coming years. So we're not going to get a lot of growth from our market from earnings, and valuations are not that great in Australia either. They're sort of, close to average, even a little bit above average, certainly compared to global standards. One positive would be if the RBA does cut interest rates, if the Aussie dollar does weaken, it would breathe life into some earnings, particularly from companies with offshore exposure. But again, if that's an environment where global equity markets are turning down and global earnings are slowing, it's not a particularly great environment. So all I would basically say for our market at this stage is we are beholden to what happens globally. And you can see there the relationship between the Australian market and world markets. Typically when there's big downturns globally, we tend to follow. The one difference was during the dot-com bubble back in the late 1990s, where it was the tech sector particularly that was hurt, but because we don't have a lot of tech exposure, we weren't as hurt. But otherwise, I think if the markets do have a big sell-off, I'm not necessarily saying they will, but the risks are that you're going to get more downside than upside. We're going to follow suit. In terms of opportunities, I'll just conclude with some ideas. Late cycle opportunities. So basically, start off with the first slide. I mean, just to reiterate, BetaShares, we now have 50 funds. If you go back to the first slide, we now have 50 funds covering all manner of asset classes. I couldn't hope to go over all of those, and not all of these, make sense from a tactical point of view all of the time. So what I will share with you is, I think what I would term late cycle opportunities at this stage, and this is now as they come up in orange. And I'm just going to go through a few of these: quality, world, hybrid, and CRED. The first one is quality. And as you can see from this chart, this is a chart of the MSCI US Quality Index relative to the S&P 500 in the blue line, and then the overall S&P 500. And what it shows is that in the later periods of bull markets, and certainly during bear markets, companies perceived that are defined as quality companies tend to do relatively well. And so quality are companies that tend to have high return on equity and not a lot of leverage. So they're really good at, they have strong balance sheets essentially and strong earnings capacity. So we have developed an exchange-traded fund in that regard. It's the BetaShares Global Quality Leaders ETF. So it basically screens all the companies, large cap companies across the world, and screens them for high sustainable return on equity. And you can see some of the names there: Facebook, Nike, Procter & Gamble, some Cisco, some pretty well established blue chip companies globally. Just the next chart just shows you again that's had a pretty good performance vis-a-vis global markets even in recent years, and in fact it's even outperformed the global another benchmark, the MSCI World ex-Australia Quality Index. So we think we've got better screens than the typical quality factor index that are available. And the difference being we really focus on the sustainability of return on equity. We don't just look at companies that currently have a good return on equity. We want to see evidence that they've had a good return on equity for a number of years and have quite stable earnings as well. So the code for that is QLTY if you're interested in like a global exposure, focusing on those leading global quality companies. The next one is more defensive areas, and again, just to reiterate, we do now have a good suite of products in the fixed income cash areas of the market. Thanks to exchange-traded funds, exchange-traded products, you no longer just need to invest in equities when you approach the ASX and invest in funds. And we have a range of products, floating rate bonds, longer dated corporate bonds, even hybrids, which offer very attractive income returns vis-a-vis more standard type of exposures such as bank deposits. And even those that, looking at if you look at typical fixed income exposures, typical bond exposures in Australia that track the what's called the Bond Composite Index, which is basically an index of all bonds issued in Australia, investment grade bonds, but it's weighted by issuance. So it means when governments are issuing a lot of bonds, as they have been of late, they take up a big chunk of that market. So something like 70% of the typical of that index is now government bonds. Our fund is we've gone the other way, and we've focused on corporate bonds, which offer better yield. So I'll just go through some of those. First one is CRED, as I've mentioned. So just to distinguish CRED from, say, the Bond Composite. And so you can look at bond exposures from two issues. One is how much credit exposure. So, for example, if it's a corporate bond versus, say, a government bond, you're taking that credit risk of, companies, given that there is some, chance that companies can go broke, you're taking more credit risk when you buy a corporate bond vis-a-vis a government bond. So in that sense, all else constant, a corporate bond should give you a higher yield than a government bond. But the other facet to bonds are their duration. So basically, how long a duration, over what is the time period over which they offer interest payments, and basically the longer that time period, the more sensitive they are to interest rate changes. So a long duration bond that's offering interest payments over a longer time period, if interest rates fall, the value of that bond will tend to go up by more than a longer duration bond, and vice versa. If interest rates rise, it will tend to go down. So CRED vis-a-vis the bond has more credit exposure, which gives you a higher yield, but it also has more duration exposure. So the average duration of bonds in the Bond Composite is about 4.5 years, and our one is about 6.5 years. Now, the beauty of that, so basically those two features, given we're both long duration, and again, the thing about the longer a duration of a bond, the more sensitivity is its value to interest rate changes, and as a result, the more volatile its returns. That then gives you a higher yield as well. So for that risk, you get compensated by high yield. So both being longer credit and longer duration means that CRED can offer a higher yield over time versus the Bond Composite. And in fact, at the moment, the yields are, the Bond's about 2.5%, and CRED is closer to 4.5%. Now, the beauty of that is you get that yield, but at the same time, you also get quite good diversification in periods of equity market decline. So the next chart shows you going a few episodes where equity markets suffered pretty chunky declines. So obviously during the GFC in 2011, over 2015, 16, and then more recently, late last year. So, equity markets down 30%, 10%, 13%, 9% in this case. So if you look at the Bond Composite, just the government bonds, and again, what you tend to see when equity markets fall, bond yields tend to decline, and that tends to boost the value of bonds. So the return on those bonds goes up. And so the Bond Composite does what it's supposed to do, and it actually gives you a positive return, and as it's called, a negative correlation with the equity market. So you tend to get, nice positive returns during periods of equity market decline. But if you look at that orange line, look what CRED's doing. CRED actually gives you at least as good and in fact better returns than what the Bond Composite has achieved. And that's because it's longer duration. So again, even though it's corporate bonds, and again, all else constant, corporate bonds should fare worse in an equity downturn because credit premiums increase and the risk around corporate bonds tends to increase relative to government bonds. But that credit exposure is more than offset by the longer duration exposure. So as interest rates decline, the capital value of CRED tends to go up by more, or at least it has gone up historically. So really it's a situation where you can have your cake and eat it too. You get your higher yield and you get your good diversification, at least as good and generally better than what the Bond Composite can do. So, CRED I think is a very interesting bond exposure if you want, if you're looking for that more to fill out that more defensive part of one's portfolio. The next one is hybrids. And again, hybrid sits somewhere between bond exposures and equity exposures. It has, features of both. Obviously, hybrids are floating rate bonds, so they're not going to be subject to interest rate changes as much as fixed rate bonds, but they do have that credit risk in the sense that, certainly for some bonds in the, the remote chance that banks, for example, become insolvent or have financial difficulties, some hybrids can be converted into equity and potentially wiped out, so that is that credit risk that you are taking with hybrids. But, it is taking on the, it does rely on, the risk that banks, in Australia could potentially go broke, which arguably is not a very high risk, but nonetheless it's a risk. And so hybrids, tend to offer a pretty good return for taking on those risks. But what I wanted to highlight here is, again, the features of hybrids generally against owning, you can get income through hybrids, you can get income through bank shares, but look at the difference of performance during equity market sell-off. So, and in fact, it's been highlighted again more recently. So when we've had those big sell-offs in bank shares, hybrids, during the GFC, even during the GFC when the bank solvency was briefly in question, they only sold off by half of what bank equities did. More recently, you've had the sell-off in 2015-16 and late last year, and the total return on hybrids hardly moved. So it's just highlighting that they are quite defensive vis-a-vis compared to, say, holding bank equity. So that's another one. So we have a fund that gives you a diversified exposure to a portfolio of hybrids, bank hybrids. It is actively managed. I won't go into say a lot more, but basically we went down the active management path with hybrids because it's a fairly inefficient market, and it's one where we think a good active manager, as we have partnered with, is able to generate some alpha returns there by buying better valued bonds than others, and also having the capacity to reduce exposure to hybrids overall when it thinks that the hybrids market is relatively expensive or relatively risky. The final one I want to share with you is what we call our managed risk ETF, a suite of ETFs. And again, in this case, we've partnered with a group called Milliman. They are they're basically risk managers out of the United States who work closely with a lot of insurance companies who basically get capital relief on a lot of their investments when they overlay their funds with a risk management strategy to reduce the downside risk. So we've taken some of their rules-based strategies for reducing risk in markets and applied that to some ETFs, in this case the Australian OST and WRLD. And essentially here it's a rules-based strategy, gives you exposure. First and foremost, it gives you exposure to both the Australian equity market or the world market, but we have an overlay such that whereby when equity volatility picks up, the rules as judged by Milliman tell us when to reduce risk in the market. And we tend to reduce our risk as volatility picks up, and the end result of that, the goal is to reduce downside risk, particularly during deep down bear markets. In smaller sell-offs, you're not going to get much upside, but it's not really designed for that. This just shows you in this chart, since the inception of our WRLD ETF, for example, in late 2015, you've broadly got similar performance to just having an exposure to the world market. We haven't any really big bad bear markets, so that it's not really demonstrating its benefit in that sense, and it only really shows that benefit during bad bear markets. But even over this period, there have been periods of equity market decline. As you can see, these are the drawdowns from previous peaks, and so particularly in early late 15, 16, and more recently, when you do get these sharp sustained declines, WRLD has tended not to decline by as much, and so that's really showing what it can do when you get sharp declines in market. So again, if you want equity exposure but you're worried about a big potential downturn in the markets at some stage over the next year or so, then this is an interesting exposure to have as well, a managed risk overlay. That's pretty much it. So just obviously some issues to keep in mind. Investment risks, returns are uncertain. you know, so all of these funds that I've mentioned have various risks, be it share market risk, currency risk, interest rate risk. As Sarah mentioned earlier, you know, this is just general advice. This is not personal advice. I'm not aware of any of your personal situations. So should you want more information, certainly seek out some professional advice. And all of our funds have, you know, product disclosure statements attached to them, and you can read more about the specific risks of each of those funds. So thank you very much for your time, and happy to take some questions.
Thank you, David. That was great. So we've just had a few questions come in, and we've probably got time for two quick ones. Just your thoughts on target US 10-year bond yields during this year and 2019, 2020. So your thoughts on that and any implications? Sure.
Okay. So last year, I mean, basically, you think back to what happened last year, they were gradually rising through most of the year. By late September, they'd gone from about 2.5% to about 3% by September. They actually briefly touched 3.25%. And that was then the catalyst for the equity market to start to sell off. And now bond yields have come back down. I think last reading was around about 2.6. They got as low as 2.5 or so. Look, I think they're going to go on the view that the Fed is going to raise rates again. I think they're destined to go back up again. But I would be saying, you know, probably 3% could be the 3 to 3.25%. I don't think the markets would be able to withstand much more than that. You know, if they got much higher than that, I think the equity basically would be a rerun of what happened last year. The equity market would sell off, and you know, fears of further interest rate rises would unwind. So I do think they're going to rise, at least over the short run. But again, bigger picture, when and if the US economy does turn down and the Fed goes on hold, and you know, there is a chance the Fed could go on hold, and you know, some suggest could even cut rates in 2020, then bond yields are going to decline again. And so I'm not super bearish on bond yields, because I'm not super bearish on US inflation on a sustained basis. I don't think the CPI inflation, which is running at about 2.25% at the moment, sort of a little close to, a little bit above the Fed's target. I don't see that really breaking out in a big way, even with you know, wages grinding higher. The problem for wages is probably going to put downward pressure on profit margins and hurt earnings more so than lead to a big flow through to prices. But I'd be targeting, you know, 3 to 3.25% at some stage this year. But that is based on the view that the Fed would start to tighten again.
Okay, great. Just another one here from Derek. Your view on the availability of housing credit in Australia going forward. You did talk about the approvals on that downward trend, and just how much the availability of housing credit will impact the housing market.
Yes, look, in terms of credit, look, basically if you have good credit ratings, if you've got, you know, a good job, stable income, not high debt, I mean, credit is freely available. Banks will lend to you. So the idea of there being a massive credit crunch out there, I think, is misplaced. It's certainly not the case. For more marginal borrowers, higher risk borrowers, I mean, and, you know, I hate to say it, even small businesses that, you know, had maybe not very well verified income and expenses, they're going to find things tougher. And there has been a general tightening of credit for the more high risk parts of the market. And unfortunately, that is going to be a thing that I think is going to stay with us. I mean, what we saw coming out of the Hayne Commission, a lot of those hard luck stories were basically cases of people that got credit that shouldn't have got credit at the end of the day. And then they're blaming the banks, you know, for having lent them the money. And they're not going to do that. You know, they're going to be thinking twice about that. The responsible lending provisions are going to kick in now. So it will be tougher. It will cost more. But otherwise, the bigger picture in terms of also what's happening in the housing market, I agree. Look, a lot of what's happened is it's not a supply constraint. It's really a demand constraint. Affordability in Sydney and Melbourne reached such a level that it was hard for people to go out and borrow more and pay more for property. There just reaches a point where affordability gets so poor that people can't pay a lot more for housing. At the same time, you had a big shift in the interest by foreign borrowers, because we increased taxes on foreign purchases, and the Chinese themselves clamped down on capital outflows. So the shift by foreign buyers and also just poor affordability has led to a decline in demand for credit, and also just a little bit of you know, the fear of missing out. You know, I guess elements of a bubble in 2017 where, you know, people were just paying over the odds because they just thought prices were going to go up forever. That sentiment has now shifted, and so there's been a you know, natural pullback in the market as people think, well, hang on, maybe prices could fall a little bit lower. Maybe I should hold back here. So I don't subscribe to the view it's all the credit crunch driving this. It's affordability, it's demand also, and that's why, as a result, even if the banks turn on the taps again and lend more, I don't think you're going to see a big rebound in house prices because on the demand side there's still issues.
Thank you, David. Just in the interest of time, there are this webinar will be recorded, and we will send out slides to everyone who is registered. However, just in the interest of time, we've got a few questions specifically about some management fees and specific ETFs, which we will answer directly with you. But please visit our website. David sends a quick Bassanese bites on Monday morning where he provides that weekly snapshot of the economic market and also any insights. Just a quick sort of 2-minute read on a Monday morning. And there's also the newsletter, which is sent out on Wednesday. So if you do want to keep in touch, please, if you're not already, sign up to those 2 emails. And as I said, we will send out a recording and the slides, so you can take a closer look at some of those charts, which may have been a bit difficult to read. We always welcome your feedback. Please let us know if you've got any comments or suggestions. But we do thank you for your time at our first webinar of the year, and we look forward to seeing you next month and during 2019 for the BetaShares monthly webinars.
Thanks
a lot. Thank you very much. Bye-bye.
Bye for now.